Yo, good evening, everyone. Can you guys see me? Can you guys see and hear me? If you guys don't mind, you can unmute yourself or like I can if you want to show your video, it's fine also, so I can see you guys. So today will be a quite an informal session. We have quite a small group, so just feel free to you know just take it as a small group session, so you guys can spend more time with you guys. You can ask any questions that you guys have in the back of your mind. Can you guys see and hear me? And all. Okay. Okay, we will just wait a while, see who else is joining. And how are you guys doing, man? Okay, so right now there's only four of us. Maybe we can go one round and you guys can share like how are you guys doing during this period, especially with this lockdown. And and also so it can be your work life, your personal life, how are you coping with this? Because this might affect your portfolio. So if there are some changes to your daily life, your daily routine, be it your work or your personal life, it could be like an additional mental stress to or something new, right? That is in your life, it could affect your investing also. And share a bit about how is your investing so far also. So we just anything there's only quite a small group here. Maybe we just take like 1 minute for each of you guys to share out. Okay. So maybe Calvin, you can go first. Calvin, you can if you can unmute yourself. Yeah, you can go ahead.
Okay, are you able to hear me?
Can.
Okay, there's nothing much changes from my side except working from home.
Okay.
So, yeah, for work-wise, there's nothing much. It's just that it's a bit boring working from home because you can't socialize with anyone. You get what I mean? Only with your family members.
Okay. Okay. How is your portfolio right now? Like anything you want to share?
Yeah, my portfolio. Okay, I just entered two more trades of getting share for JD and SQ. That's all.
Oh,
So
JDSQ.
I'm
Okay.
still holding, yeah, I'm still holding on to my dip calls, which I entered during all-time high in late December, early January.
Mm.
So yeah, last week it was in red about losses about 1,900 USD.
Okay.
So this week it was better. The losses has it decreased to around 1,000.
Okay.
Yeah, the bulk being Baba and Visa. These two are the main.
Okay, can. So for late cost that you entered before the drop, right, it will still be at a loss for the most part. Yeah, then that one really, late call really need the patience. Or if you want to keep them, especially if you enter before the highs, you need to wait for new highs before they can recover. So
Yeah,
a lot of
yeah,
patience.
there's one question because you see especially for Baba, this week Baba is starting to recover, but it seems that the dip call is not recover as fast as the share price. You get what I mean? Like
Yes,
the
so
share.
the the price are not accurate on a short term basis and also because sometimes the P&R spread is quite wide.
Okay.
So I don't really look at the so for lead call specifically, right? Don't look at the short term movement. Don't see like, oh, today up how much, tomorrow down how much. That it does not correlate that much to the actual Alibaba the share price movement in the short term. So that is one thing to take note. So there's a this what call it, there is quite a bit of difference between the so for example, right, like the stock market and the real economy is totally different, right? I mentioned. So similarly, right, in the stock market itself, the lead call, the share price, how much profit and loss today is very different from the actual share price also. I mean, there's some correlation, but sometimes the pricing is not accurate simply because of the B and R spread is very wide, right? So on a day-to-day basis, if you want to like, how come if you're asking, like if you get puzzled or confused, why today Alibaba went up so much, but my lead call actually it can be negative. So sometimes it does happen, right? It's a normal thing actually. Yeah.
Okay.
Mm. Right. Okay. So maybe Kevin, you choose who do you want to pass the mic to, Darren
Uh,
or Samantha?
let's say Darren.
Okay, Darren, how are you? Let's go.
Hello, can you hear me?
Yes, can.
Yeah, can you hear me? Yeah, yeah, okay. Yeah. So basically, yeah, been very, very busy. actually been very, very busy since start of March when the market crashed, because there are a lot of queries from our clients also, and also things like we have more meetings, I would say, to analyze the market and things like that. So
What you
yeah, so
in the
yeah, sorry.
what's your line of work?
So I work in finance, so asset management.
Oh,
Yeah.
okay.
Yeah. So when the market crash, and then yeah, there's a lot of like queries from our institutional clients on what's going to do next and things like that. So yeah, so we have to sort of analyze the situation for them, and also like to reposition their portfolio and things like that. So yeah, so it's a bit challenging these few weeks I would say. Yeah.
Okay.
Yeah, that's why I'm very busy. I didn't really have time to go and catch up with all the readings and stuff. Yeah. So
I see. So it just for you lah, maybe, or for everyone also. Like busy is you can't help it, right? It's a job, but also you don't want to like while you are especially when you're working asset management, like busy for clients, but you want to at least take a bit of time for your own portfolio, so make sure you don't miss out unnecessary.
yeah. So for my side, right? So I bought lip calls for JD, Baba, and Disney lah. I think it was some time back lah. So I think similar to Kevin, I think we also had a lot of losses, quite a huge loss lah at some point in time. Then after that, recently it started to recover, especially I think JD it went up quite a bit. Yeah.
JD hit a new all-time high.
Yeah. So JD went up quite a bit, and but Baba still halfway there, because I bought it at quite a high price at the time. Yeah. So it was still like in the rate for about 500 like that. Yeah.
Okay. So your trades like Disney, your lip call, you also entered before the drop, or?
Most entered before the drop. Yeah. That's why all are all in the rate now. So and I stopped like buying more already because I think that the market now is very, very volatile. So I don't think I want to buy more lip calls. And yeah, and so I'm looking for opportunities for those kind of short-term trades. So I'm doing some short-term trades on using oil, and also some of the leverage ETF that I tried. I mean, not bad actually. Some of the leverage ETF are making quite a good profit. Yeah.
Okay.
Yeah, but it's a bit very, very volatile. So that one I learned from my colleagues one. So I just follow them. Yeah. So not bad. So make quite a bit of 50% from those trades. I think. Yeah.
Okay. And Samantha, are you there? You want to share?
Yes. Yeah. I just closed one sell put
Can speak
on
a bit
Visa.
louder.
Oh, sorry. I just closed. Can you hear me?
Okay. Yeah. Can.
Okay. I just closed a sell put for Visa yesterday at 5 cents.
Awesome. Okay. Yeah.
Yeah. So right now my portfolio left only the lip call which I bought during before the crash on Visa also, and there's one buy put that I bought during the crash until now still not yet recover. So I'm not sure what should I do on that trade.
Buy put. Buy put.
Yeah, buy put on the EWI.
Oh, okay. Yeah, I think I have it. I have some EW. So, okay. You continue first. Okay.
Yeah, so basically I left only these two trades.
Okay.
Yeah.
So generally, like for me, right, you must understand the intention when you do buy puts, right? So I do it as a hedge. If your portfolio is not much trades to begin with, right? Not much bullish position, there isn't nothing much to trade. There's nothing much to hedge. So for example, right, if I mean like start home lockdown, right, I'm not going out, right. At this point, there's no need for me to buy umbrella. You know what I mean? Because I'm not going out. So it doesn't matter if it rains or not. I'm not going out, Like it doesn't affect me. So when you buy hedges like buy put or EWI, right, it's because most of the time it's because we have bullish position. Bullish meaning positions that will make money if the market goes up, and if the market goes down, we'll lose money. So as a hedge mean it's inversely correlated, right? So we want some positions that is a counterweight to our main portfolio. So if you do not have too many like bullish position, or if your portfolio is slightly smaller, it will not make sense to buy hedges in the first place. So this one I will cover a bit more later on. All right, but
what about if let's say previously my portfolio for bullish position quite a lot, that's why I buy this EWI. But it happened that after I bought, the market never continue drop, so that this buy put I can sell back at higher premium.
You can close. So actually, I also have my own buy put. I typically, because why? Because like for every update, let's say tonight the market, like last time the market went up a bit. My buy put will lose a bit, right? But
Yeah.
I will make like 10 times more on my bullish position at least. So if you're not making like on updates, if you're not making 10 times more, then or like 5 times more, it don't make sense for the buy put. So if I mean, and let's say you only have two positions, right? One is your buy put and the other one is your dip call, is it?
Yeah.
In that case, right, I might just close it at a loss. It's fine because you cannot see your hedges as an individual trade. You must see it as a whole of your portfolio. While this buy put you lose maybe $100, for example, your other bullish positions are making so much more to cover this loss. Does that make sense?
Oh, okay.
Think of it as a whole portfolio.
Okay.
Yeah. So for example, I can think of it like if I buy an umbrella, I carry the umbrella out. But if it doesn't rain over the next 10 days, it's okay lah. It just costs the umbrella money. I mean, okay to lose it. So you can think of it in this manner. Yeah. So for all of you, right, try to think of your positions not as individual positions, but as a whole. How is your whole portfolio, working together? Because very much the whole portfolio, right? So try to see it as a whole together. Okay. So maybe later after I share what I want to share, we can have another discussion, and maybe when you guys have a bit more clarity, we can come back to some of the questions that you guys have, and or for your individual portfolios. Would that be cool?
Yeah. Yeah. Sure.
Okay. So today, right, the agenda. Let me share my screen. Can you guys see? Can you guys see my mouse also? Or just my slide? Can see my mouse, right? Like where am I pointing? Okay.
Yes.
Okay, awesome. So today we a few things. So today will be quite a short session, so I don't want to bombard you with too much stuff. I know everyone is like with this COVID-19, everyone is like stressed out and all that. So I just want to keep everything short and just cover the main things that I want to address, and what to look out for the next few days. So firstly, I'll cover the market outlook, how I think my own bias on the market outlook, what I should take note of, my personal plan, and importantly, what your plan can be. And also, right, so the plan is like more into percentage and all that, right? But after that, when we talk about individual companies, right, I will talk about like why we should focus on the right companies. So I think even like previously, right from the get-go, when we started in late March or what, right, I already mentioned like why we should not, pick the wrong companies. So companies like, I think Darren, you mentioned you got Disney, right? So Disney is a company that I personally will not have lah. Like for example, right now I can always, the moment I realize Disney is a company that is affected by COVID-19, I can straight away switch it out. So I take the loss, I switch it out. It's a dip call, right? So I can switch it out. I use the dip call on a company like JD instead. You know what I mean? Over the last few weeks, I might have made more. So the opportunity cost, I'll cover a bit more on that. And I will share with you up and coming sector. There's a sector which I feel in the next bull run, it will tend to do, I think it will tend to do well. And I'll cover more on it later. And then after that, Q&A. All right? So let's go. Okay, so you all can see my face also, right? Cannot. Okay, so this is the daily chart. So some of you guys know I use this thing called analog wave to help me check the markets now. So for me, right, this analog wave, right, it sounds very cheap, but it's more in layman terms. It just give me an easy way to help me to navigate the market. So it's kind of like a lighthouse. I'm a ship in the dark, right? I'm trying to get to shore, and it's a lighthouse pointing the light like that. So based on this analog wave, they have been doing very well for me in the last few years, right? Like so, analog wave, right, it usually track. I think I showed some of the charts, over the last few weeks or so, right? We actually caught the low somewhere around here, and then we bounced up. So right now we are about here, right? 2008 like that. 这边 can see over here. So So this is a long-term plan, and in the long-term plan, right, the analog wave is saying that we should continue to go up. Like, can you see my orange number? 1, 2, 3, 4, 5, all the way up. So analog wave is saying that very likely the bottom is in, and we are on the next bull run up already. Okay, so this is a bigger time frame chart, and let me zoom into the smaller time frame. Okay, so smaller time frame is this is the hourly chart. Okay, so this is what this is the previous slide is here. Okay, so here if we, so you can see this 1, 2, 1 and 2, right? Is this 1 and 2? Okay, so right now we are somewhere around here, right? So this whatever you see over here is over here. You can see my mouse over here. Okay, so I'm just zooming in. So I show you guys the bigger forest picture first, and then now let's zoom in more closely into where we are right now. So the bias right now is that as long as, okay, so right now there is a bit of battle between the bull and the bear, and we are stuck at like 2007 to 2009. S&P, so this is SPX, this SPX, that means the S&P 500. So as long as we remain above this line, that means above this purple arrow here, this line, 2007, we are pointing upwards, all right? But right now also, we need to break the 2009 level first. So when we are in this what I call a no man's land, right? Like we still do not know, do we confirm for sure going up, or do we still have a chance to drop back down? So right now there's no 100% confirm in the markets, and there is a small, I would say significant enough chance, maybe 20-30% chance that we can drop down for another low. All right, but as long as 2007 holds, I will be looking upwards. All right. So until here, right? Any questions you have before I proceed? Because I understand this could be a bit technical, and there's a lot of things I want to share. So there will be adding on to this chart. But do you all understand over the last 5 minutes so far what I'm trying to say? You can unmute yourself or something.
Yes, for me.
Okay.
Yeah, yes.
Okay, quite clear.
Yes.
Okay. So, so the purple one, right, is the alternative, the secondary outcome. All right, but as long as we remain above 2007, which is this pivot over here, we are looking upwards. Okay. So this is the technical charts that I'm following closely, and I think this is how the market is going to pan out. We will slowly. So this whole thing, right, like from here up to 3, 4, 5, it will take weeks or months. It will be quite a while. All right. So during so that over the next few weeks or months, it will still be very volatile. It will go up and down, right? We do not know how it will play out. But during this period, right, I will be positioning most of my portfolios to about like 50% weightage, like 50% or 60% weightage, so about half, all right? And if we can break out above 2009, which is around here, if we can break out the previous high, 2009, and hit higher, right, the likelihood that bottom is already in, which is here, is higher, right? It's much higher, and I will just be looking for the next high, all right? So I will slowly, that means I will start to increase my like aggressive position. That means like, so I'll be entering a bit more in terms of percentage. Also, the positions I enter will be more aggressive in nature. For example, I will start to be adding dip costs. I'll be adding dip costs back into it. So like for example, right now I have a minimum allocation of dip costs, but the moment I break above 2009, I will be entering more dip costs, because dip costs, if it's a bull market, it will make a bit more. It will make more. All right. So I'm waiting for sort of a confirmation that we break up above 2009 over here, which right now we still do not have. We are still in between the no man's land 2007, 2009. All right. So my plan is I will have 50% weightage, and if as we continue higher, because if I feel that the bottom is in and the next bull run is going to begin, as we continue higher, right, the plan is to trim. We need to trim our positions. I will be trimming a bit lesser also. So not overly. How do I put this? Like if I go cut my hair, right, I don't have to trim too short. keep it a bit longer. You know what I mean? Because if I think the bottom is already in and there is not that much downside, I am not that like eager to trim my profits. Right? So this is just me personally. And also, when I'm holding 50% positions, right, I am leaving myself half of my portfolio as cash in case we drop back down. So in case we break the 2007, I mean, okay, the 50% I'm already in, I do not cut. All right, I just keep it for the next wave up. We will just go back down here. All right, and if we continue to go back down here, right, I will start to add my remaining 50%. I will start to add at when we are around 2004. Right, 2004, you see on the right side, 2004 is here. So once, if we break down 2007, from here to here, right, I probably will not be doing anything. I don't want to leg in from at least 300 points here. I want to wait for here to start to leg in as we approach this bottom here, the next low, right? So this is my rough plan. So right now, I think we are probably the bottom is in. We should be looking upwards. I mean, 50% in. But at the same time, can you see, regardless of my bias, I am positioned for both outcomes. If we continue higher, that's great. I got 50% weightage. I can start to add in my dip cost. But if we break down, it's okay also because I can add more at a lower price also. Right. So this is my plan. But more importantly, what can you take away from this, right? So most of you guys have your portfolio management plan, right? You can enter and change based on your allocation, right? So you can follow that plan. And those of you, right, who you are feeling a bit more FOMO or aggressive right now, you can take the opportunity to load more. You can load more. That means if you load more, right, and if we break down over here, right, you must be comfortable with the job, all right, and you must be able to hold them for the long term. So if you what do you call it? If you're going to load more and if we drop down here, if you are going to cut loss, right, then don't do that. No point. Does that make sense? So if you want to enter a bit early, it's okay. So you're a bit more aggressive. But if we drop down, right, you just have to be prepared to hold them for the short term, right, for the wave down and then go up again. So this is my tip. And if you're loading more right now, don't do lead cost, right? You can sell put to own the shares, right? As long as the stock selection is good. Like for example, if I buy Visa at a slightly higher price, it's fine. You know what I mean? So it's okay to load a bit more. Okay, those of you who are more conservative, so Kevin, I see you raise your hand. Give me one. So those of you who are more conservative, you can wait for this thing to play out first. So we can ding dong all the way up to 1. We will probably come back down here again. Here is almost the same price as here. So you will not miss out too much. You will miss out maybe 6 months worth of time, right? Well, which during this period, I can be selling puts to earn some premium, all right? So, but if you are more conservative, you can still remain a lighter allocation, maybe 30% allocation. And as we go up, we will probably come down here again. So those of you who are more conservative, you can wait to see how this thing plays out first. Because if we go up and come down, right, it's a totally different story already. When we go up over here, the likelihood that the bull run has come back is pretty high. That the market, the bottom is already in. From here, right, it's very unlikely we will continue to drop back down here. So from here, we have to pull back now because we go up like that, we have to drop somewhere, right? So this will be a good. So these two over here on the right side of the screen will be a good opportunity to enter the second wave. All right. So in case you want to skip this move up, it's fine. You can wait for the next boat over here. So this is just for those who are more conservative, or you want to sit this one out. Like if your buyers think, wow, with everything that's still going on there, how can the bull market come back, right? That's like, if that is what you think, you cannot sleep at night. You think we probably will drop further, then you can stay away for this wave up. It's fine also. Okay, questions? Kelvin, you got question live? Kelvin, you can unmute yourself.
Yeah, I was thinking based on the dynamic portfolio, okay, but you were saying that when it reaches 2009, okay, you will enter more.
So 2009, yes.
So it's like it's different from the portfolio planning, right? Because it's like portfolio is the other way. When it dropped to 20%, we will enter a certain amount. When it dropped to 40%, but this time it goes up. So we are more aggressively entering into more leap costs. Because actually that was that was initially my thinking. I'm holding back to see a sign that the bottom is in, so I will buy more lip call.
So it's a bit different or counterintuitive from the dynamic portfolio management that you guys learn. That one is more straightforward, like you follow mechanically, no need to think. This one is more additional knowledge input, and because of this additional knowledge, you are making adjustments to it, to the plan. All right. So so when I share just on my own plan, it's also for some of my more aggressive portfolio. Like why do I want to add the dip cost when we break above here? I want to ride the wave up. From here to here is quite a good. So this one not everyone need to play this, right? Because we can come back down. But if I want to earn this part, I can do something about it also. And when I say go aggressively, it's not like when we break above 2009, my portfolio suddenly from like 30% suddenly become 100%. No, it's like maybe right now I'm at 30-40%. Once we go up above more, I will slowly start to increase 50%, 60%, slowly increase as we go from here to here. Yeah, and over here, once we reach like somewhere around here, I might choose to. So I will put my. So from here to here, right, my trimming right won't be evenly. I will do most of the trimming around here. From here to here, I won't do anything. Once we start to reach this part, I will trim some, right? And then when we drop back down, all right, I will enter even more. So this is a plan that is more based on technical than the portfolio management. All right. So this is just something I'm just sharing what I'm doing. It's just something for you to consider, and you feel like, hey, this system actually, like what Kevin you said, like you want to waiting for some kind of like confirmation things are better. You want to enter more, then you can do this also. So 2009 and 2007 will be the battle lines up, all right, of this like go and bad, and let's see like which one break first. Do we break above 2009 to continue pushing upwards, or do we break down below 2007? And to be honest, both scenarios can happen, right? I'm not saying it's we confirm bottom in C we will keep going up. There is still a likelihood that there's still a chance that we might drop back down. So I am prepared for both scenarios. So right now, right, whatever your plan is, you just need to know if either scenario happens, right, what are you going to do? Right? If we go up, what are you going to do? What's your plan? And if it goes down, what's your plan? Right? Your plan don't have to be similar to mine. I'm not showing what I do. I also shared how you can play it also. Right? You can follow your portfolio management plan accordingly. Keep things simple. It's fine. As we go up, you trim profits. As we drop down, you enter a bit more. As we go up, you take profits. Drop down, you enter more. Keep things simple. Second, if you are more aggressive or you have feeling more FOMO, once we break above 2009, you can look more also. You can enter a bit more positions, a bit more lead costs, etc. also can. Right? Just a bit more. It's not like suddenly you switch your whole portfolio to lead costs. That is too extreme. Okay, I'm just saying slow. So any tweaks or any additions or to your portfolio should be gradual, slowly. Okay, not like overnight your portfolio totally from self-put, you close everything, all become lead cost. Not like that. Okay, so this is something, don't go extreme. Right. At the same time, if we break down, so like if I go a bit more aggressive, but suddenly the market break down, it's fine. Right. I choose to be aggressive, and if I'm wrong, my bias is wrong, and we drop down, I need to be okay to hold it for this wave down, and then we come up again. Right. So this is just something to consider. Okay. And if you're more conservative, you can always sit this out and hope that we come down so you can look more. And if you're more conservative, you don't want to enter too much. You want to wait for it to drop down, also can. And if you drop down, then good for you, right? Then you can look more over here. But if you choose to be conservative and we don't drop down, we continue to push higher, you have to don't FOMO lah. All right, don't let your FOMO, or rather you be FOMO lah, but don't let your FOMO affect you, and wait for the second pullback. Because when the market goes up like that, so you see from here, this is a drop, right? We go back up to almost the new high, it has to have a pullback mark. So you can wait for this next pullback. After we go up and come down, the next pullback to load up also can. Okay, so that's another way. All right. Okay, any questions or anything you all want to ask more in detail about? Anything? I can't see if you all are typing anything. Okay, everyone okay. Okay, just type okay so I know everything's going well. Okay, all right. So let me move on. So this is a general plan, right? So this is just I'm just sharing this how I see the market from a technical point of view, all right? How I see the next few weeks and months. And of course, if I will be sharing the 2007, 2009 pivots, right? I will be looking at it closely. The moment we break either one, and then what I will be doing about it, I will definitely be sharing in the group chat. All right. So more importantly, right, is you need to have your own plan. Okay, what is your plan? And focus on your plan. Okay. And once you have your plan iron out, right, like you have your companies iron out, right, don't be seduced because the news will be very volatile out there. Every day more people are dying and all that, right? And sometimes like right now there will be new stuff like oil prices just drop and all that. So I think if you have a bit more experience in it, right, it's okay. Like for example, Darren, because you work in asset management, if you know how to do like leverage ETFs, then I think it's okay. But if not, right, for the most part, right, you should stick to what you know. And I just want to be very transparent. I just share what I did yesterday. 2 days ago when the oil prices went negative. So I seldom trade crude oil, but I thought like so I really know crude oil price could go negative, but I thought in Think or Swim at least, right, if the chances of it happening is very low. So what happens was I go and sell a put on crude oil at a strike of $1. And the worst thing I can do is at $1. I thought I cannot. So there's a likelihood it go negative, but I thought the chances was very low. So I thought it was like a good thing, a risk reward play that I can do lah. So what happened was overnight. Luckily for me, I only did one contract. Right, so I lost 2K in one contract, like in just a few hours. The moment I sell, the price goes south. That contract started expanding, so I got a bit worried. Then I called them. Then I realized that it can actually go negative for futures, right? And what happened was because it wasn't an instrument that I was. It's not my usual insurance, so I don't understand that how it works that well enough. But despite of that, I still went in against my own. Yeah, I can say against my own rules, and even my gut feeling was telling me that perhaps I should not do the trade. But I would say a bit greedy. I thought like if I'm in, so I show you if you guys don't understand let me share my thing also.
So you mean you bought an ETF or you bought the future?
I sold a put on the future. So you all can see my thing also, right? Can see? Can see my thing also, right? You all are looking at my thing also right now, right? Okay. So I sold a June expiration. So June is 21 days to expiration. So June is actually May. All right. So because it's futures, the way it's structured, it's just 1 month. 1 month. So like right now, although it shows June, but it's actually settled 1 month earlier. So it's actually 21 days to expire. It's a 3-week trade. So what happened was I sold a put around here. When I sold so this is a strike $1 mark, correct? I thought crude oil. So this is crude oil futures. That means the future price of crude oil. I thought it should not drop to crude oil should not drop to at least the future price of crude oil. That means you tell me right now future oil prices is negative, okay lah. But I will expect in the future crude oil prices should go back up. So in the future, 3 weeks from now, crude oil prices should be above $1, right? So this is the assumption. And when I sold this, right, can you see is for selling a put is right now it's even more than higher than $1. Can you see? So it's almost so if I click confirm and send. So the maxi. Okay, so this is the thing. For crude oil, right, one contract is $1,000. It's not 100, right? It's 1,000. So theoretically my max loss so I thought, right, if I were to sell a put at $1, and it dropped to 0, my max loss should be 1,000, correct? So and if I receive 1,000 plus, it's like a shelving kind of trade, all right? But then comes the question: if it's a shelving kind of trade, right? Why do you think the price is like that? All right. So that is something that but back when I was doing the trade, I did not think about this. Or I thought about it, but I just somehow my brain did not process it well, and I just did it. So what happened was, right? Luckily, I was still considering doing a few more contracts, but luckily I did just one, and so I sold one put. So because crude oil is 24 hours. So if you look at my timestamp over here, can see my mouse. I did it in the afternoon. Okay. And I sold it for back. It was 38 cents. Right. And then actually that very night, midnight, before I went to sleep, I just wasn't comfortable holding it overnight, and the price just keep going down. So I opened for $380. I sold for $380 because it's times 1,000. So I shift the decimal place 3 times. It's $380. I closed it for 2,002. So overnight, in just a few hours, right, I lost like $2,000 just for my greed. Luckily, I only do one contract. So this is just something. So why am I sharing this? It's just to say that even experienced investors like me, and not just me, some of my other trader friends, they also did this mistake. So you must understand, right? Especially for those who have been trading for a long time, right? Crude oil did not. I don't think crude oil actually, or oil prices in general, did not actually went negative. It was like the first time in the history of oil that prices actually went negative. So it's something that is hard to contextualize also. Can you imagine? So that was why people are, and because of this volatility, you must imagine that there will be a lot of people asking, hey, crude oil, hey, oil can buy or not? Oil can buy or not? Now so cheap, now it's negative, can buy or not? You know what I mean? So, and if I can able to make mistakes like that, do you think, if you're a bit more new, you might end up losing even more if you do not know what you're doing. All right. So this trade, obviously, I decided to just close it for loss because the loss can be unlimited on the downside. You don't know it can go negative how much, right? So I'm just sharing this. It's a very good learning experience for me. I spent 2K to find out that I should not be tempted by shining objects, right? It's a very, very good. So I can look at it as I lose 2K, or I use 2K to buy me a lesson that will be much worth the price. All right. So any lesson that I make, any mistakes that I make, I always make sure I learn from it. All right. So this is something that as investors along the way you might make mistakes, or somehow you might one way or another you might make mistakes. Is what you take away from it. All right. So making mistakes is okay. I think it's okay. Even though there's money involved, we can't avoid one. No investor, even Warren Buffett, he picked the wrong company sometimes also when he was on the way up, correct? Much less us, right? But it's important what we learn from it, right? So yeah, this is my crude oil, how I lose 2K in a few hours, okay? So yes, so back to the topic, right? I sidetrack a bit. Don't be, you all can see back to my slides, right?
No, you got to
Okay.
share again and then.
Okay, wait. New share. Okay, can see now.
Actually, Remy, what's the difference between the crude oil future and the ETF?
Okay, good question. Okay, so let me explain this in a bit of time. Crude oil futures is futures, or how to say, that means like futures. Firstly, what is futures? Futures is the future price of the crude oil. Does that make sense? That means like right now there's a price, and then there is a market price that says 3 months later what will be the price, based on your own assumption of the supply and demand. Does that make sense? So future prices might be different. So for example, crude oil price could be $50 now, or negative now, but 6 months later, people might expect this whole thing to be better, and they will expect crude oil prices to be higher because if someone invent a cure, people can go back to work already, correct? So crude oil prices should go up, theoretically, correct? So crude oil prices will be a bit different. So why is there even futures in the first place, right? So how did futures started, right? It started as a form of hedging, correct? So let's say if I'm an SIA, one of my largest expenses will be oil prices, correct? Right. If like suddenly there is a war in the Middle East, then me as an airline company, I'll be affected. So what I will do is I will buy insurance on oil prices. So in case oil prices goes up too much, I can use the whatever money that I place on the futures as a hedge. Right. So this was how people use futures, and not just on oil. It's on any commodities, and usually it's commodities like rice, coffee, soya bean. You know what I mean? So this is why this was how future markets actually got started. So how is it different from the ETF? Depends on what kind of ETF also. Oil, there is a few different ETF, right? So for example, like USO tracks a few of the futures. So it's a bit complicated actually if you break it down. Right? And then OIH is like it's an ETF of a few like oil mining companies. Right? So there's a different mixture. Then XLE is like companies like ExxonMobil, Chevron, that kind of companies. All right. So there's a bit of difference. So like from what I understand, USO cannot go negative because of the way it's structured. So the way it's structured matters a lot also. So because I did not understand 100% fully contextualize that futures can actually go negative. So I thought my max loss was actually like $1 drop to zero. I did not expect like zero right can drop to negative 100. You know what I mean? So my max loss was much. My risk, so I miscalculated the risk. All right, I thought my risk was capped at zero, but actually the risk can go much lower, much higher in this context. All right. So one thing I take away from this, and one thing you guys can take away from this is, if you do not understand it perfectly, right, you probably should avoid, especially if it's a last minute thing, like suddenly overnight oil prices drop, everyone is looking at it, you want to get in also. You know what I mean? It's probably a full sums game. That means like if everyone suddenly like if almost everyone can know that oil prices drop and want to get in to buy oil prices, right? Probably there's that the trade is not good enough to make money. Does that make sense? So this is just something to think about, all right? Yeah. Okay. Any other questions on this crude oil? Wait, it's just I was just sharing because it's just a very recent incident that happened to me. Like I just 无缘无故输2000块. Yeah. And this is something that very long never happened to me really. Yeah. For the last few years, I very seldom will do this kind of thing. I think last few days too bored at home. Then when I woke up, then I saw like, actually can. Why not I just put one contract and try first? I didn't know what was I thinking. But sometimes this kind of thing happens. So for me, right, as an investor, it's very important to take things with a pinch of salt. That means like if I make money, it's no big deal. If I lose money, it's also okay. I learn from it. Right? So what I mean to say is like, losing $2,000, no one feel good about it, but don't let it affect me or yourself too much. Okay, so this is just something that as investors, because as investors, right now, actually for most of you guys, if every day, if your mood is dependent on your portfolio, like tonight market go up, then you feel better. If market go down, then you feel very sian. It's actually not good. So I'm not sure if any of you are like that, but if it's like that, right, you PM me. All right, we need to talk. Okay.
So it's okay to trade in ETF for oil, as in buy sell put.
I mean, okay, so since you asked, and I think if everyone is interested, let me share my thing or swim. So if you want to do like oil plays, right, what you can do instead, or what I personally might want to do, okay. So I actually somehow I just don't feel comfortable. I think it can very well. You guys can see my thing on screen, right? So I close everything except oil positions. So you can just look here. I have lead calls on USO. Okay, I have different expiration also. But all of them are losing money. Okay, but it's more of looking for the reversal here. So you can buy lead calls. If you want to sell put, right? So let's say you want to sell at the money put, you can do something like that. So there's a few plays available. Right now, USO is at 2.5. So, okay, this is the thing. When I call thing or swim, anything in doubt, right, always double check. So I call thing or swim. And one good thing I learned, right, was thing or swim, they have, I think just recently, they have overnight support. So I'm talking about thing or swim Singapore. So thing or swim Singapore, they have their daily hours is like 9 to 5, right? 8 to 5, all right, 8 to 5. Then they will have 8, okay, so it's 8 a.m. to 5 p.m., right? But after that, market only open at 9:30. So at night, right, they will route the telephones to the US side. So at 8 p.m. our time, the phone line will open until 5 a.m. Some angmo will pick up the phone. Okay, so in case you got any problems or what, you can call them. So what I did was I actually called, and they confirmed for me that futures can go negative. but USO should not negative. And even for them, right, I'm not sure if they do not know or they just don't want to guarantee or what. They cannot say 100% for sure USO cannot go negative. They only say like 99% should not go negative kind of thing. That's the essence I got from them, which don't make me comfortable selling a put on USO. You know, the USO, the way it's structured is based on futures also, right? But with the assumption that it cannot go to negative, you can, let's say the max loss is until zero. If you sell a put here, you will earn this premium, $44, and your max loss is all the way drop to zero, correct? This is you can do something like that, or you can sell at $2 strike or whatever, or you can actually do a spread. But also know, because the price itself is very low, and then you minus off the commission, it's not worth it as a trade. I rather if you want, you can do lead cost instead. So this is
Actually, I did a lead call at $6 for the December 22.
This one correct, same as mine correct?
Yeah, correct. I did one contract with it.
Yeah, so I think it's okay. This is like a high risk play and can don't need to do one up. But if you want to do right, keep to, for me, I firstly right, like position size, right, how you allocate, it depends on your confidence on it also. So for me, I have very, very little confidence in oil prices rebounding. And even if oil price rebounding USO, the price might not rebound that high also. I will not know, all right? Because of the way it's structured and the way there's so much uncertainty with oil. It's not like equities where, so equities is something that I understand better. Equities meaning like Facebook is a company, right? If it makes money, in the long run, the share price will go up. It's a more straightforward thing to understand than oil price. There's so many other political factors surrounding it compared to Facebook. You understand? Or like compared to Visa. So if there's more uncertainty, my conviction and my confidence goes down. All right. So if I do not have a lot of confidence in it, I am not going to put a lot of my portfolio into this. So it's just something like what I call a lotto play. That means like I buy 4D like that. I just put 1% of my portfolio, try it. It makes some money, great. It doesn't, it's fine also, 1%. You know what I mean? So you must set aside a maximum amount for this. Don't go and average down, double down, and then suddenly you have like 10 or 20% of your portfolio in this. This is something that I will not recommend. Okay. Just something. Okay. Any other question? Darren, Samantha, you guys okay? Okay, ma?
Yeah, okay.
Okay, okay, so I go. Yeah.
Yep, okay, yep, okay.
So this is US, this is oil. Okay, so personally, with all the uncertainty, I don't want to spend, I don't want to go. So this is one thing also I learned. You do not have to get into everything on. Not every single thing out there, you need to 拍只脚进去, you know what I mean? Not every single thing out there you need to step one foot in. Okay, anything that is not within your conviction, you have high confidence in, not within your circle of competency, right? Ignore lor. All right. If I just ignore oil this trade, right? I save $2,000. $2,000 can buy how many cup of bubble tea? You don't know. Okay, so this is so at least I learned from it lah. All right, so I definitely will not be making this kind of mistake next time. Yeah, so really, like we have limited amount of cash. What we want to do is put it into the trades or the companies that give us the most return, like in the sense that we have the most confidence in also. All right. So like when it comes to oil, right, it's just something that I mean, on hindsight, it's easy to understand that, hey, why in the first place I get it? Like, firstly, I don't have confidence in it. Secondly, I already know the prices can go negative. Third, if so many people, at least in my in my investor group, everyone is posting about it, everyone talking about it, everyone looking to get, even people who do not even buy stocks are trying to buy oil. Probably means that it's something that will lose money already. You know what I mean? So just something to take note of. Okay, so let me go back to my. So you can come back to this later, but let me go back to my what I want to share for today. All right. And okay, the next part I want to mention, right, is so we talk about portfolio management, and I want to address this part also. Like, find in your portfolio, right? You all know, need to buy companies, ride the wave up, trim profits when it drop, enter more and all that. But one thing that you only think of also is like entering the right growth counters. Okay, so I see even right now I still see maybe not exactly three of you, but I see classical, very common mistakes. Like people will buy these kind of companies like Starbucks, McDonald's, DBS Bank. So these are the companies that I personally I do not think they have the best growth, right? And I covered this. Those of you who need a refresher, right? I covered this in the last webinar, right? The grade A, grade B, grade C companies, right? So please go and refresh, right? Why like companies like DBS Bank, do not belong in it. There's just you just talk about DBS Bank, right? There's not much room for DBS to grow. Singapore is so small. Like yes, DBS is a safe bank, but we're talking about when you buy a company, you're talking about the future growth. If you're buying for dividend, then okay, like you are looking for more for retirement. Like if you're going to retire next year, then okay, your portfolio might be structured more towards dividends companies, and that's okay. But if you're still growing for the next 5-10 years, you want capital appreciation, then DBS Bank is a company that you should not get into, right? So I just show you an example. So somebody, if you all maybe cannot visualize, right? And some people don't agree that, hey, why DBS Bank cannot? I thought DBS Bank is a good bank. So let me share with you. So, politically sensitive, I need to say that I'm a very proud Singaporean. I love my country. I love DBS Bank, our favorite local bank, right? But when it comes to investing, right, I think there are better opportunities out there. And so let me share this is Yahoo Finance, right? And see? So let me close off everything. And this is Exxon Mobil. So this is DBS Bank from the last. So Yahoo Finance, right? They have, you can enter the chart and then you can do comparison. So just imagine people ask me, hey, Wei Ming, if I bought, just imagine if you bought DBS Bank 10 years ago during the 08-09 crash, your returns are not exactly fantastic. You just look at the chart. So let's say even you buy at let's say you time it to the lowest, you bought at $7 and you hold to the high, okay, you sell before the COVID-19, right? You make how many times? So the best you can make is 5 to 6 times. That is provided you time at the lowest and you sell at the highest, which I don't think you are able to do that also, right? But let's say you buy an average price, you call it somewhere around the way down, maybe $10 or something, and right now it's at $18. And you see over the last 12 years, your $10 to $18 is not even one time, right? So you don't exactly make a lot of money. So this is DBS Bank, and let me compare to, let's say, and if over the same period, right, if you bought something like MasterCard instead, can you see the difference? If you guys can see the difference, right, just type OK or something in the chat so I know you guys can see this screen. Can you see like? Yep. So this is what? This is the real opportunity cost. So let's say you take, let's say 12 years ago, you got some $5,000 or few $100, you buy DBS Bank, compared to someone else, let's say me, I bought MasterCard. Our return is, can you see the difference here? You, instead of making minus 16%, you make 1,400. This is not dollars, this is in percentage. You see the difference? And if you have a company like Facebook, okay, Facebook I think haven't IPO back then, but where's Facebook? Okay, Facebook only started here. Okay, so Facebook only got a few years, so maybe not the most accurate, but let's say we use what other companies you have in mind? Now will be a good time to validate. Apple. Can you see the difference? Is the difference between so right now with the same amount of money, what you do with it matters a lot. Right now, I still see people like taking that amount of money and buying SIA shares. That is like, or DBS Bank. That is like something that, yeah, I don't want your next 10 years to be like that. If you get the idea, I don't want your next 10 years to be like this DBS Bank, the blue line here. Okay, if you can choose a green line, why you want to go for the blue line? So the blue line, by the way, is DBS Bank. So this not because I don't like DBS Bank, but because the last 10 years 是这样. Okay, so you just something for you to take on. So later on your own time, when you're free, right, you just enter your favorite company. Even a company like Nike should do much better also. Okay, why? Simply because in Singapore there's not much room for growth. All the top companies in Singapore, your STI, Straits Times Index, your top 30 companies in Singapore, You just all put off. In fact, let me enter STI here. So our straight time index like the jump row, and let's see. Can you see over the last 10 years we are like over here? It is the purple line, straight time index, which means to say if over the last 10 years being a Singaporean you want to support local companies, you buy STI and then you just quite go and hold long-term investor. But you long-term on the wrong stock, can you see the very different 10 years of opportunity cost is just gone like that? So please, your next 5 to 10 years, I don't want it to be like that. So this is why selecting the right companies is so ever more important right now. Okay, so you'll get the idea. Let me go back and do my slide. So how many of you actually 3 of you only, how many of you didn't know actually DBS Bank did not make any money, or like even your STI is like did not really actually make that much over the last 12 years? We all thought like the last 12 years actually should be went up a bit. I don't know how much, but I thought it should went up a bit. How many of you actually thought that? Yeah. So this is something. So and this data is available, right? So Kelvin and everyone, right? We should, based on our decision on numbers. So yeah, doing okay. So everyone thought it's doing okay, Singapore should be doing okay, right? So yeah, this is no one want to see the harsh truth, but me being me, I just share with you long. So this you should something to keep in mind, all right? So yes, so Singapore stock is a different way to play, obviously. If you want it for dividend, I think it's okay. So like, on the other extreme, if I have some CPF money that I cannot take out anyway, it's locked down, I can use it to buy DBS shares or buy some local REITs, give me 6 to 7% dividend. I think it's okay, all right? But if I want for growth, for capital gain, then so you need to decide like why do you have the company, all right? Is it for growth or is it for dividend? So before this question, right, you ask yourself right now with the money you have, how much should you put in growth and how much should you put in dividend? Okay, if you still can grow at least for the next bull run 5-10 years, right? Like for me, I'm in all 100% growth. I do not want any dividend. Like if I can make the money on Mastercard, why do I want the 7% year after year? You go and compound, even you add the 7% in, how much money will you make? All right. So later, in your own time, you can do this. So let me go back to my screen. So I hope this is informative for you. So the opportunity cost is very, very real. Something to take note of, right? And a whole lot of difference. So that's why selecting the right companies is ever so important. Like 10 years ago, because I didn't know, I thought I know I need to invest. I know I need to do something. But if I invest in the wrong company like CapitaLand, my very first company that I invested in, CapitaLand, right? There is a lot of opportunity cost that I wasted, right? So something to take note of. And yeah, those of you can recap on the previous video. So what are great companies actually? Why the graph can go up so much? I mentioned that, right? So you want to find companies that have a long runway for them to grow. It's very easy for them to scale up, right? So when you talk about scalability, right? If you have writing materials in front of you, that'd be great. So as I say, you can write down. You want to find companies that have low human involvement when it comes to scaling up. Low human involvement meaning it's not like Starbucks or McDonald's. Every time I need to open a new outlet, I need to hire 5 new staff, right? So it's more like if I am Facebook or Mastercard. If I buy a pen on Mastercard, the cost is the same for Mastercard, right? If I buy 10 additional pens, 10 times the volume, they make 10 times more, but they do not need 10 times 10 other staff to be there to make my money. Does that make sense? So it's very easy, scalable in the sense that not much additional human involvement, all right? And second, right, is low capital low asset intensive. That means I do not need to be like very heavy on okay, I use back the same McDonald's example. Every time I open a new outlet, besides the 5 human beings, 5 staff that I need to open the outlet, I still need to either I rent or buy the place, the corner shop, right? There's money. Second, I need to renovate the place, right? And third, even after I do the one-time renovation, which is cost, once a while I still need to touch up and all that. So can you see there is like it's head, and then the equipment, the coffee making machine, all that. All this is money, correct? So it's capital intensive, which is something that I do not want. So I want a business that for me to scale up, no need human being involved, and it's asset or capital like. Okay, so that's something that you should take note of. And number 3, right, is ideally it should be non-physical product. Non-physical product. So if I'm selling like Netflix, it's online, right? Like you just watch the movie online. like Facebook, it's all videos, it's online software. So because it's non-physical product, it's very easy to deliver, and at the same time, right, it's very low cost for them. Does that make sense? I don't need a warehouse to store my coffee beans. Like if I'm at Starbucks right now, I literally need some warehouse or logistics to store my coffee beans. Yes, but for Facebook, they just need some virtual storage, then that's it. So these are companies are firstly very low cost, and for them, low cost is one thing, and for them to scale 2 times more, 5 times more, 10 times more for the next few years, their cost will not expand that much. Okay, so these are some of the factors that you should. So in your watch list that you have in mind, if you want to run through, do they fulfill these kind of characteristics? And are they COVID-19 resilient? Like Disney, right, is a company that I cut long time ago already. So that one you can think about for Disney. Like why? I don't know how long this COVID-19 will last. All right, and I mean everyone knows no one is watching movie. Disney is our favorite movie company now. Okay, I love Disney. No one is exactly watching movies right now. Yes, and movie production are delayed. Yes, they have Disney Plus, but they are still, it's still a burning money. They are still burning money doing the content. And previously, before this COVID-19, year after year, right, 50% of Disney revenue actually come from, 50% of the revenue actually come from where? Your type, maybe besides movies, right, where do you think their revenue come from? So a big part of their revenue actually come from this component. You want to guess what is it? Type in the chat box, right? Let me see if you all can get it right. Are you guys still here? Or you all can unmute yourself and chat. Where do you think 50% of Disney revenue come from? Yeah, there you got it. Theme parks, right? So yeah, amusement park. So Disneylands around the world are closed down, and probably we really do not know how long will it be closed down for long. And Disney is not exactly a company that have the best cash flow in the first place already. And then with this situation, will they be affected? Yes. So yes, right? So in all answers here, they are actually severely affected by COVID-19. So their business over the next few months will not be that great, right? Then the question is, then with my money, right, why do I not want to deploy it to other companies that will be doing better, like whatever I just mentioned, or more COVID-19 resilient? They are not as affected by COVID-19. For example, JD.com, Amazon, their business actually better, right? Their share price actually went up a bit more. Or Facebook, Visa, these are companies, right? So that's something for you guys to think in mind. Like some of you might be thinking, okay, because I did a lip call before the share price drop, before the drop in February, March, right? I want to wait for it to go back higher first. So this is what call it? You are stuck to the loss, right? You're thinking from a big even point of view. Another question to ask is with the same amount of money. So if I cut loss, right now I get back this amount of money, right? This is really the amount of money that I have right now, because if I cut loss right now, this is the amount of money I get back. Using that same amount of money, if I put the money into companies that might be doing better, is it a better utilization of the cash I have right now? So this is something. Yeah, actually, Darren, you want to share, like, what's your thoughts on this? Since you have Disney, and again, I didn't specifically pick on you or what. Just nice that you mentioned you got Disney, so I use it as an example. All right.
Yeah, for me, I feel that Disney, right, I thought I was quite well diversified. I think he has media networks. I mean, revenue streams, they have theme parks, they have media networks, they have studios also. And also they have those kind of like direct to consumer and international kind of like a business, basically the segments. Okay. So those kind, I think includes kind of merchandise and stuff. So I think it's quite well diversified. I didn't expect it to be so badly affected by this COVID-19 situation. So yeah, so I understand that they closed a lot of their theme parks, and the only thing that can operate now totally is the Disney Plus, which is not doing very well also in a sense because it's still burning money.
Yeah. So actually, yes, there are 4 major components, of which, right, I think 3 out of the 4, actually all 4. Okay, I think it's 3 out of 4 are not doing well. Their ESPN channels are not doing well also, because the whole plan was to legalize betting, on sports, right? And now no sports really, ma. So like you can't exactly get in groups to play soccer or hockey, right? So it's a company that I personally don't feel comfortable investing in. So previously, I'm not sure if you missed it because you're busy also. Like I shared quite a bit on Disney and why we should avoid it. So those members who actually have Disney, I told them to cut. I mean, like I cut my own Disney, and no one's feel good cutting losses. But as an investor, it's we need to think from a not from a take profit or cut loss mentality, but at any point of time with the funds that we have right now, what is the best way to utilize and to deploy them? It's just like if I'm a general in war, right? It doesn't matter how many battles I won before, how many soldiers I lost, how many soldiers died in battle already doesn't matter. More important is right now with the resources I have, with the soldiers I have, what is the best way to use them, right? To win the war, correct? So that is a better how many soldiers die beforehand doesn't matter to what is going to happen in the future. So whatever is the losses that you make previously does not really affect your future, correct? And if you use it to affect your future, it's not it's not exactly the optimal way lah. Does that make, I hope that makes sense to you, right? So yeah, so maybe you guys can share also like based on what I shared, what kind of companies do you think will be okay and will be the kind of companies that we should be picking, for the things move on now, especially with this COVID-19 theme that we have in mind. You can unmute yourself, you can type in the chat box, anything. Just share. But just want to make sure you guys get it. Our e-payments company, okay.
Hey, how about companies like Microsoft?
Yeah, software companies, right? Microsoft, Adobe, these kind of companies should do well, right? And I also think so there's a few trends now, like software companies, all your tech companies, but it's actually people say, wow, so much tech, is there a risk? Actually, tech there's they have an immune system to COVID-19, you realize? For tech companies like Google, all this. So with the new age, with this COVID-19 especially, I think tech companies actually did pretty well and will continue to do, like just compare like company like any tech company or any e-commerce company like Facebook, Microsoft, Amazon. Over the next 1 or 2 years, right, they will leapfrog the traditional companies like Coca-Cola, Disney and all that. Simply because during this period, Disney is burning money while Microsoft is still doing okay, correct? Can you see the gap here? So they actually leapfrog their competitors. Do you think their share price might actually leapfrog them in terms of like going upwards? So when the market recovers, not all companies will recover equally, right? Some will go up a bit higher. Disney one fine day will go back to the highs. But while it takes that time to do that, let's say 2 years, the next 2 years, during the next 2 years, Microsoft share price might go up even higher. So we are already seeing it like in Amazon, JD, all these companies, they already, like right now, the market still have not really recovered yet. Amazon all-time high again, JD all-time high already, right? So these are some of the companies that I personally will think of. And I think Tesla in the electric vehicle scene also, like after this, more and more people will be more like environmental conscious and with the knowledge in like electric vehicle is just simply it's a cheaper car, and every month you don't have to top up petrol, right? You just charge the battery, you save up. It's just a no-brainer for the next wave of car buyers. So if Tesla have a big market share in that area, I think Tesla is one of the companies that I personally like, right? So I think I also shared. So you all can watch the video. I think Darren, you have not. I think the last video you did not watch, right? So you can check it out also. The previous video I shared a few more examples. Obviously, like Visa, Mastercard, e-payment companies, online shopping, software companies, right? Zoom, Adobe, Microsoft, all these. These are and for China, I like JD lah. Right. So these are some of the companies that you can invest in. Okay. So and again, right, I need to emphasize that there are so many 101 companies out there. You want to pick the best of the best, right? So that to give you the best results. Okay, so you do not want to stuck in a company that has less than ideal. Anything that's less than ideal, not the best of the best, I do not want to be invested in really. So like for example, I always ask myself I think Disney is a good company, but is there a better company that I can put my money on than Disney right now? if the answer is yes, then the question should be, why am I not doing it, right? So just something to think about. Okay. Any questions on this, on these grade A companies and how we select the companies? Okay, if no question, just like no or okay in the chat box, so I when everyone's okay, then I can move on. Okay, so the next part I want to talk about is biotech. Okay, so I think biotech, right? I'm not sure if anyone is familiar with this sector, but biotech is not a sector I'm familiar with also, but it's a sector that I think in the next bull run out, right, they should do very well, or they should tend to outperform the general market. Why? Because traditionally, or based on market cycles, right, biotech, especially the smaller biotech companies, right, they tend to do well in the last stage of the bull run. So right now, the next bull run, I think we are in the last stage, so to speak. Right? If I look at okay, like this last stage, so from 4 to 5. So over here, this blue box on the top right, we cannot see, is where I think is the next and the last bull run for since the start of like 2008 until here, right? This is like one cycle, okay, one full cycle. So this is, I would say, the last leg up for the whole cycle. And in the last leg up, right, I think biotech should tend to outperform some of the other sectors now, right? So this just, I don't know how to explain it. There's no logical explanation for it. There might be some, correlation to it, but like I can find some data to prove it. But it's just my take that it can outperform. So what I want to do to capitalize on this, I will just, firstly, I don't know which companies to choose, so I will choose the whole ETF, either XBI or IBB. These are both ETF. XBI is, so the difference, more or less the same companies, but XBI, right, has more weightage to smaller companies because it's like equal weightage to each company. So let's say 30 companies is equal weightage. Whereas IBB, they give more weightage to the larger capitalization companies. Right. So XBI, because of this, there's more weightage to smaller companies. So my preference will be for XBI. And XBI is slightly lower in price, so it's easier to enter and exit. So my play, right, will be to do leap cost. I won't go into leap cost strategy because you guys should know that already. Why leap cost, right? Because it gives me the best bang for buck. If I see it like going, if it's going to outperform the market, it should go up a lot, right? And if it's going to go up a lot within a short span of time or within a limited time frame, leap call will be the best way to play this. All right. And also, why I do not consider other strategies like selling put to own the stocks and all that, simply because biotech is quite volatile also. It can get up or down a lot compared to other sectors. And it's an industry that I do not understand well enough to own their shares. So if you ask me to make money on it, I'm okay. But if you ask me to own their shares, I don't want. So, and how to do this? The only way you want to make money on them without owning their shares is using Bitcoin. So this is the play I will do. And again, because it's just a high, I would say high risk, but I would say it's a slightly outside what I usually do. So it's just something that I just want to try. I am not going to allocate too much of my portfolio to it. So for me, I probably will not allocate more than 5%. And this 5%, I'm not going to enter all in to get like one time like 5% cut down on the dip cost. So what I will do is probably I will start legging in some dip cost right now, and then as we start to go up, right, I will start to enter a bit more like more dip cost. So in actual fact, how it actually works is that so let's say I go back to my thing of swing. So XBI is over here. So dip cost, right, I'll be choosing the last expiration, obviously. So I'll be choosing somewhere around here. So right now it's at about $94. So I will look at the open, firstly I'll look at the open interest. So I also noticed that the last expiration is about 600 days, which means the new expiration is going to come out already. So, but as and when it have not come out, I just use this. But when it come out, right, I want to do the next one. So once the last expiration for all these like ETFs start to get to 500, 600 days, usually the next date will come out already, right? Just something to keep in mind. So when I glance through like that, right, I noticed the open interest is not exactly very high. So, but if I'm just doing a few contract, doesn't really matter. But I will try to avoid these two lah. I'm not going to choose these two. It's like under 10. And this one is 120 strike. So I will probably choose like 120 strike or $100 strike. All right. And let's say lah, 5%. Let's say I have 100K portfolio, 5% will be 5K. So let's say I allocate max 5K to do this. What I will do is, so I can mix things up. So maybe today I can enter like 5K. I can break down into like 3 or 4 tranches, or like 2 or 3 tranches. So maybe today I do one. I enter, let's say market open and the price is around here. I will enter around. So let's say, so you guys know how to enter, right? Try to beat the. So Shane just joined us. So I will try to enter, like what I mentioned to Shane the last time, right? When you entering the call, you want to try to beat at this price first, right? And then slowly increase your way up to the mid price, right? So, and let's say I manage to get in at $14, for example, all right? That's 1,000 for out of the 5K. So I will then maybe over the next few days or so, or few weeks or so, if the price go up or go down, I can actually enter more. Okay, so this is how I might link into my lead cost for XBI, all right, for the biotech sector. Any questions on this? So this is just something that I think I just have the hunch that XBI might go up a lot. Okay, and so it's just something I want to share with you guys. If you guys got a bit of extra cash and you think biotech is something that you want to have in your portfolio, don't mind try. But if not, right, it's okay also, can ignore. Not and I say again, you don't have to do every single thing that I share one. All right. Any questions? You can ask. Okay. If not, right, maybe you guys can share also. Like based on this last 1 hour or so, right, we covered quite a bit of things, right? What do you learn from it, right? And is there anything that you can actually implement for your portfolio, right? Anyone want to share? So besides Shane who just joined us, Darren, Samantha, Calvin, anything that you feel that you might be implementing for your portfolio, or how will you be adjusting your portfolio, or any questions that you have about your own portfolio or general question, now is the time to ask. If anyone want to share, you just unmute your mic and share along. It's just a few of us here. Maybe everyone just take 1 minute to go. Calvin, are you here? You want to go first?
Okay, yeah. First of all, the most important takeaway for me is the first chart. Where you say if we start to go up at 2009, we can start to enter more. Because
Okay.
initially I was following the dynamic portfolio.
Okay.
Get what I mean? So
Yeah.
it was like actually I was planning to enter more where it start to goes up. But looking at the portfolio, looking at the dynamic portfolio, actually I don't have to enter anymore if it goes up.
Okay.
Because practically I have already you should know I have already PM you about I just injected another
Yes.
funds into the
Yes. Yeah.
account. So apparently I missed the bottom. So actually this fund was supposed to come earlier so that I was expecting another drop so that I'm able to enter more. But seems that's never happened. So initially I was thinking that there's no more chance to enter based on the dynamic portfolio until the market recover to a stable uh, situation. Then I will think of how to enter again.
Okay.
But after this, I can understand that even when it goes 2009, I can start to enter maybe another lip call or JD or maybe SQ or maybe even Visa.
Okay.
Yeah, so that is something that is important to me because now I know that I don't have to wait for another bottom to enter. Because if it doesn't come, I can go the other way to enter at where it goes above 2009 where the bull run starts. So
Okay.
yeah, that is the most important
Awesome.
takeaway from me.
Yeah, I think the way you are thinking about your plan, like if it goes once we break above 2009, you're going to add positions. I think it's fine. Yeah. If you do that, right, you just need to think of like if you add and then we drop back down, like I assume you're selling puts and all that. So if we drop back down, you will get assigned on the shares a bit earlier lah. You must be okay with that lah. As long as you're okay with that to get on the boat a bit earlier, then I think it's fine. All right. Okay, thanks for sharing. Anyone else? Darren?
Yeah, for me, I think the Elliott wave is quite interesting. Yeah, so something that I never learned before. And it's more the technical, it's more the TA side already, right? The technical analysis side already.
Obviously it's very, very technical. It's
Yeah,
totally discount fundamentals one. Yeah.
Yeah, so because I'm more of a FA guy lah, fundamentals lah. So I would look more at the company fundamentals and stuff, look at their balance sheet and stuff, and whether their strategy is working or not, stuff like that. So yeah, so it's something that I'm trying to learn also. Yeah. Yeah, and also another thing is the part on the I would say finding the right companies. I mean the opportunity cost. I think that was very important also lah. So maybe I want to consider cutting my Disney after this and putting into some other companies. I think
you should lah. And also last few days maybe Disney bounce out a bit also, so might be the right time.
Yeah, now Disney is above 100 now, so I think maybe it's a good time to cut.
When we talk about opportunity cost, I understand. Like for example, Disney over the last 2 weeks it bounced up quite a bit, right? It goes up quite a bit.
Yeah.
But also the last 2 weeks, right? Other companies actually went up even more. You know what I mean? So
yeah, especially JD lah.
Yeah. So if you have, so let's say 2 weeks ago you cut Disney at the worst possible time, but you allocate the funds to a better company like JD, you might actually make more. So this is where opportunity costs come into play lah. So this is so this way of thought process actually convinced me that I can cut at any time. Like why? Because if it's not the best company to hold, cutting it like right now immediately is the best thing that I can do, because then I free up my funds to put it into a better companies. So this is something that it's not easy to. I mean, it's logically it's quite easy to understand, but to really internalize it and really execute on it, right, is something that we need to get a hang of it lah. All right, something to keep in mind. So like one question you can ask yourself, right? Like almost every week I will ask myself this question. So for me, subconscious, I'll ask myself, hey, my portfolio, right, is this the best it can be right now? If I were to, let's say right now, if my net liquid is 100,000, that means if I close everything right now, loss or gain, whatever, right, I get 100,000. So that's a net liquid figure. With this figure, right, will I be entering into the exact same position that I have right now? Because if the answer is no, or if there are some difference, then the question becomes, why am I not making the switch? Because if the reason for me not making the switch is because I want to wait for you to get back to break even or make some money, my 10% profit or what, then the challenge, the counter to this is, if you make the switch, that new company have a higher chance to make more, because that is your preferred company, that's a better company, right? So like based on fundamentals or what, then why are you not switching earlier? Every single week or day you are delaying your own opportunity cost. So I think Darren, you got it up. So just something you need to internalize it and work on it. Like make it work for you. Like knowing is one thing, but how is it helping you is another thing, right? Something to take note of. Okay, Samantha, you got anything you want to share?
Based on the chart, because if let's say right now it's still between 2007 and 2009.
Yeah.
So I'll continue doing selling put. So if let's say it dropped below 2007, then I can get the shares that I want.
Okay.
So if let's say it go up to 2009, then maybe I will do some lip call.
Okay.
Yeah.
That sounds okay. Like so, when you are doing all these changes, right, you want to, depending on how big your portfolio is, you want to do it gradually. So it's not like suddenly we break above 2009 and when we say break above 2009, we can all go recall and 100% recall. No, please don't do that. Like slowly make it some recalls along the way up. Okay. So this to here it won't be overnight. It will be over at least a few months. There's plenty of time. So you want any changes that we make to our portfolio, we want to do it slowly, especially if you are new. Yeah, but I think whatever you shared, I think it's a good plan. Okay.
But how to allocate the percentage if let's say for this case?
So let's say, I'm not sure portfolio is how much, but let's say based on 100K portfolio, and right now if I do not, or right now you only have minimum, and let's say I have 50% weightage right now, of which right 10% is on lead call, so 40% is like self-put, own the shares really or whatever, 10% is lead call, right? The moment we break through above 2009, I will start to increase my overall weightage, but I will tweak more ratio to lead calls. So right now it's 4:1, right?
Yeah.
For self-put or for self-put or buy and hold to one lead call, 4:1,
Yeah.
right?
Mm-mm.
When we break above 2009, I might tweak it to maybe 3:2 or something like that. So I will start to tweak my ratio in terms of my lead call of my whole portfolio to be higher, slightly higher. And it's a slightly, it will be a gradual increase kind of thing. So from 4:1 to 3:2 is quite a big difference, right? It's like a 10% shift. The 10% is not overnight. It will be a month like it will be slowly increase.
Okay, understood.
Yeah, something like that. So this is
Yeah.
I think it's a good question. Everyone can learn from this also. Okay, awesome.
Yeah.
Yeah. And I think for Shane, are you here? Shane?
Yes, yes,
Yeah, so you join us
I'm here.
later. Anyway, this will be recorded just for you. You'll be out.
Yeah, thank you.
And also,
Just now I was attending the Crypto Nights webinar.
I didn't know in studio. So yeah, so you'll be uploaded. Those of you who want to rewatch this Darren seminar, Alvin, you can rewatch. Once I upload, sorry about that. Okay, it's open. So I'll be uploading this later. So Shane, for you, you can you only watch it to to get yourself up to speed. All right. But
Thank you so much.
anything you want to share? Like how you just recently joined, so like how is your portfolio? Quite okay, right? Any questions you have?
No questions. Still trying to see how best I can position my portfolio in whether it goes up or down. So I think your analogy where if you like something, then you take more bites of it. Then if you don't like something, it doesn't mean that you don't eat. I think that's a very good analogy. So we are also not sure whether there will be a double bottom or you'll be a V-shaped recovery. So we should position ourselves such that we can profit in both ways.
Yeah, awesome. So I actually shared just now earlier a bit of my views on whether we are we going to come back down in purple for this double bottom, or are we continue going up? Later you will watch it up, right?
Okay.
So, and then and after that, if you have any questions, ask in the Telegram group lah. Okay.
Okay. Thank you so much.
And for the rest of us, right, I don't have anything much. So right now, right, the next 1 month, right, is really just seeing. So the first thing, right, is I want to see 2007 or 2009 break first. This is a no man's land again, and right now we are still there's this battle zone between the bulls and the bear. Let them fight. All right, it can take a while. It's okay. I'm not in a rush. I am positioned accordingly. But the moment if we break 2009, which is my buyers, then I will start to do. I share my plan, right? I will start to do accordingly. But if we break down further down, we break the 2007 support, or that means that probably there might be a higher chance that another lower bottom is there, then I will play accordingly also. So right now for the next few weeks, I'm just waiting for this to play out. And in the meantime, those like let's say I'm allocated 30-40%, I'm selling put, didn't get to own the shares, I'll just keep doing just keep doing while the market is fighting it out, just earning premiums along the way. All right. Okay. So I will, and those of you who have, I think was Samantha, and any of you who have hedges, right? If, like I mentioned earlier on hedges, right? If your portfolio does not have too much position, there isn't really any need for hedges. So you also can just keep things simple and don't have hedges. Right? Just have bullish position only. In market drop, you enter with more. Market go up, you trade. It's easy also. Okay, don't have to have hedges also. It's fine also. All right. Any other? Okay, if there's any other questions, if you don't have questions, market is open. All right, we can. I'm not sure if today is update or what. I think it's update. So, and hopefully we might be able to break 2009 tonight. Then, then there will be more interesting. So right now it's just playing a patient kind of game. There's nothing much we can do also. But once something more tangible comes in, then it will be a bit more exciting, right? And I'm waiting for a nice down day or few days of down day, so I can actually do like more trades. Then I'll be doing live sharing, live trading with you guys. Because over the last few weeks, there isn't, as the market keep going up, it's all trimming profits, and then nothing much that like no real trades that I will be doing also, right? So hopefully over the next few weeks there's more volatility, and actually more volatility, that means more movement. Is actually good for me lah, personally, and I think it's good for us also, so we can go in and out at a better price. Like right now, if you realize when you sell put, right, the premiums are getting lower and lower already, right? So there's something to take note of lah. Okay, other question, like I will see you back in the Telegram group. All right. So any questions also, feel free. Over the next 2 weeks, everyone is adjusting to this lockdown at home. I understand that, especially those of you who are busy, but it's important to think of also, you do not want to, too busy until you do not have time to spend on your portfolio. All right. These are just something to keep in mind. Okay. Or if you are too busy, right, you want to make sure your portfolio can have a more passive approach. Like, can I just own some shares and just leave it for the long term? Like, if I buy the right companies, as I mentioned earlier, it's also easier. Okay, so you must realize your plan, right? There is a different roads to go. Where it doesn't like have to be a straight line, or it doesn't have to be this particular plan. Like a dynamic portfolio management is a template only, right? If it does not suitable for you, can you come up with your own plan that works better? Can also, right? So as you think about all this, how can you customize all this dynamic portfolio management? This plan sounds good, but how can I improve on it so that it's more customized or more suitable for myself, right? Some questions that you want to keep in mind. Okay. Okay, so some of the other stuff I'll be sharing in the group chat also, right? So if there's no further question, I will end this webinar, and I'll see you guys back in the group chat, right? So have a good evening. We'll see you guys. Bye-bye.